Hello, ladies and gentlemen, and welcome back. Well, just when you thought we were going into a recession and jobs numbers were dropping, the US economy hits back. Hiring surged throughout January, 517,000 jobs added. The expectation was between 180 and 200. Now, how does this fit into our current market thoughts? Well, today we try to answer those questions, but it certainly makes sense to why Jerome Powell on his Wednesday meeting and Q&A didn't really have much to say. In fact, he just kept saying, we're going to leave rates higher for longer. He obviously had insider information there. And when you think about it, what did the market actually do? Well, yes, it sold off after a little rally early in the session, but realistically, it was all about forward yields. In today's video, we're really diving deep into what happened exactly on the bonds market because it was a shock across the board. And just as all of this is happening, we have more retail participation. You, me, everyone out there in the community, we're back. And we're back in big form. In fact, JP Morgan has said that 23% of market participation is now retail as of January 23rd. So it's clear to see that stocks like Apple and Tesla are the place to be at the moment, including some massive volatility. Join us as we cover stocks, commodities, and cryptos in a whole bunch of detail. See you soon. Well, welcome back everybody to the Daily Show where we talk about markets around the world. We've got the news, the macro, the lead indicators, and the key levels that you need to be watching this week for all the markets. They're coming up later on today. But let's begin with the jobs number. 517,000 jobs, 3.4% unemployment rate. Wow, that's a hugely low unemployment rate. And it doesn't just stop there. November and December were both revised up, 34,000 and 37,000, bringing us a total of 71,000 higher jobs numbers. Yes, the US economy is on fire at the moment in a kind of semi-good way, and it does bring up the question of whether we're in some kind of engineered perfect soft landing. But the markets for now, how did they respond? Well, they basically went out there and they changed all of the yield curve expectations, which will show you on charts moving forward. Smart money versus dumb money confidence. Yep, this was a huge switch. We've been covering this specifically since 4K. Do remember, this is only a tool. It just shows you inflows, considered smart money and considered dumb money. But now that we know that retail traders are taking over again, it makes some sense why this chart has so much disparity. Yes, it dropped under 0.3 for the first time that we've seen in some time. And we had some other big notes. Fear and Greed Index actually tapped 80, extreme greed, just before the NFP. And of course, since the NFP number, the jobs number that is, we've seen markets drop off a little bit. But it doesn't just stop there. Not only is retail participation increasing at an incredible rate, but we've also got an incredible amount of options trading. According to Goldman Sachs, on Thursday of this week, 68 million contracts were traded. I've heard it's upwards of 70 million, 40 million calls, and 28 million puts. That is kahuna numbers, and it's the biggest of all time. So you've just witnessed history in terms of what's going on with this market and, of course, the expectations that everybody has. Make sure to follow us over at Twitter, FX Evolution, if you're interested in some of those data stats that we do share. So how do we bring this all back into perspective? If you're an investor or a longer-term trader, always remember some of the biggest rules around there is not to feel FOMO and not to, of course, feel fear. How can you do that? I love using forward measures. Forward PE is always one that we're updating here on the channel all the time. And I expect this to be one of the big things of 2023 in terms of being able to make better decisions about investment. Recently, we hit the 25-year average of 16.82. Is that a good time to buy long-term investments? Well, it's the average, so it's not a bad time. I mean, for dollar cost average players out there, it's pretty decent. Now, we've seen that, of course, increase as of pretty much the time of this recording. We're sitting around 18 times forward earnings. So it's not really incredibly expensive yet in the markets, but it's certainly not cheap. I've always worked with the idea that if you can buy it kind of almost one standard deviation away, anywhere between that 15 and 13 area, it's a pretty big smiley face from me. But of course, you've got to make your own decisions, and you need to stack a whole bunch of different reasons together to be able to, of course, find those key zones in markets. So what economic recession? Yeah, well, we've not seen really some of the things that you would expect from a effectively recession call anytime soon. Usually unemployment rises from the cycle trough, and then we see some type of recession being called. That's usually 6.1 months away. And you can see on this chart the things that usually happen ahead of a recession call and how close we get. Well, with the jobs numbers coming in where they were, if we take a look at them, it doesn't look like they're properly dropping off. I mean, just to put it in perspective, 517,000 in January takes us back to as strong as the July number was. And of course, then we've got that incredible number back in 2022. So the Fed's job is not done. So what else about rotational flow have we seen recently? Well, here is a report that actually shows you the biggest players and their reports in terms of what they've been purchasing and selling recently. And it continues to be kind of sideways. The big money is still investing in this market at a faster rate than they were maybe a few months ago. October was basically the low for this investment. We've followed this chart for quite some time. The big thing is, though, they're certainly not purchasing at a rate where they're getting a lot of confidence back. You can see in the history that when this blue line really starts to pick up over 600,000 net boughts, that's when you start to see that huge investment thrust. So there's still a lot of cash on the sidelines. We speculate it's a lot of mutual funds sitting there that haven't gotten in. Eventually, they will have to pull the trigger. So do remember, if this market runs too much more, and we'll talk about some of the key levels that they might be forced in, they will jump back in and it will cause a rally in the markets. You've got to be careful about when the mutual funds do end up realistically going, okay, we have to be in now. We can't sit on the sidelines anymore. At the same time, this green line shows you commercial hedges, and the big hedges over here have continued to try to short this rally recently. Will they be correct? Well, history proves that in 2022, they were. They basically hedged heavily into some of the rallies of the SPX, and then they dumped it as it came back down. So something to be worthwhile looking at. Let's move over to the money flows. And we saw, of course, the rotation into defensives for the first time, or I think it's the second time really, in 2023. One semi-strong day for things like healthcare and staples. You might say, how are they strong? They're both negative. They held up better than the rest of the market. That's what you're looking for. Utilities was pretty concerning, down 2%, but usually you want to see 2 to 3 of the main defensive sectors coming out in front. Now, if that happens and we start to coil in the market around this level, we know, or at least we have a very good idea, the markets are ready to sell off further. We haven't seen anything like a proper stack of that yet. Now, we will be bringing up our implied volatility ranges for each one of the major stocks in the earnings this week as we continue through the season, but that will come in our next video, so definitely set alerts and make sure to watch that one. Beat rate's still 65%, beats 460, misses 244. A disappointing earnings season to be said, but overall, of course, the market has still rallied it. Now, part of that reason is the extreme selling we saw on tech stocks, and most of retail realistically watch tech stocks more than anything else. So it looks like it's an okay earnings season in terms of what's going on, but it's still a fairly decent disaster. Of course, stock buybacks and other things are running a lot of these stocks. Plus, they've just been oversold. If you're interested in following us on any other platforms before we get into the charts, make sure to check out the Linktree link down below. We've also got free trading cheat sheets if you're interested in checking them out. We'll be releasing our daily show in a snippet form on TikTok moving forward, so definitely check that out as well. And remember that we're always trying to give you guys edge, so hopefully on all of our platforms we'll be able to provide that. Definitely check us out there. Let's move over to the VIX. Anything interesting? Not really. I have got an alert set just underneath this 16 low, just in case it triggers in the coming weeks. If this ends up happening and we get something like a 43.50 on the SPY, and we're not near that yet, but if we do get a 43.50 SPX and we get a low like this on the VIX, I think that will be the last zone for the bears to truly try to take control. And hear me out, we'll talk about it later on today's video. What about US 10-year yields? This is a massive move, obviously, all the way back up to this high. Now, if the yields keep running, you've got to think the stock market will not like that and it will continue to sell off. A little alert to be set above 3.59 in terms of breakouts. 2-year yields was already breaking out to 4.3. And here's where the big changes happened. take a look at September of 2023. We're now approaching 5% again. The other day, this was down in the 4.7s. So basically it's saying we're going to get potentially another rate hike. And on top of that, we're going to hold the rate hikes for longer. Here's where things really also change. December, instead of having 2 rate cuts, we've only got the potential of 1 or even 0. That's a big move. And this is a huge switch in how the market and how the bonds market is perceiving what has to happen to this incredibly hot economy that still has work to be done. Now, it could be a soft landing, don't get me wrong. That's the rhetoric that could go around with this. But realistically, the way it's starting to pan out, it looks like we're going to be in it for longer than other people expected. 1970s, anyone? Stagflation? We'll find out whether this is sticky inflation or not. The data-dependent Fed will be heavily looking at the data now, as will the market. Resistance was formed on TLT, of course, an increased spike in duration. Yields is never good for TLT, and TLT hated it, and it sold off. We also saw that through high yield bonds. And in fact, high yield bonds actually created a little island reversal over here. Now, it's interesting because we've had this before at the peaks. Watch high yields again this week. I'm going to set a little alert. You'd want to have one probably underneath, somewhere around here to like around this 75 zone. And that's going to be a critical level because, of course, if yields, high yields especially, start to drop off and the market's coiling, it's usually a precursor of bad things to come. In recent weeks, bonds have been all about these dropping forwards. Now, all of a sudden, as the data comes out, the hotter it shows the US economy, if it is hot, then these will suffer, no doubt. Let's move over to the US dollar. Super interesting close. It took the lows. I was skeptical on this low take for a few reasons. We got back to a critical level, which we'll look at in just a second. And then the non-farmers came out. It never activated and it just rallied and rallied and rallied. Now, there's a real case to be said for a bit of a drop in the coming week and then further rallies. But at this stage, it looks like the US dollar is actually back for now. High yields makes it desirable, and it's certainly a very sneaky take. Here's the weekly, here's the lows, here's the wicks, and of course you can see where we are right now. Now, if we scroll down to something like a 15-minute chart, you'll notice that the markets obviously just rallied and continued to rally through this non-farms. It was such a surprise figure, it didn't really have those major pullbacks with it. If we do end up getting pullbacks though, something to watch will be the 102 level. For this down to the 101.60. I'm going to have alerts set through that just in case for the DXY to pull back, as I believe buyers will try to recommit to the US dollar around here. Where we thought the activation might happen is the high, the low, the higher high, and we were looking for a lower low return to short further. It didn't activate it, so it wasn't a trade. That is why we say patience, react, don't predict. If you found a key level, and no doubt that was super important zone for the DXY, you've got to have a way of activating the trade. And that's something that is very, very important. Don't just find a key level and say, oh, that's definitely a short. You want to scale in either, or you want to, of course, have other reasons to get in off those on the smaller time frames. This is probably my biggest chart at the moment. I've been absolutely going wild on copper recently, obviously on this channel, talking about how I've stacked this zone. And so far, it's been pretty good. Copper's, of course, dropped like a rock. You've gone 4.3 to 4. That's actually a fairly decent move on copper. And it continues to be one of the ones I'm watching. They call it Dr. Copper because the economies of the world rely on copper as part of, realistically, growth. When you think about any infrastructure project that uses this, the opening of China sent it skyrocketing. If we take it out and just look at it in a little bit of context, we can see that we did have a huge distribution that led us to believe copper was going to go short. We've rallied up to the key zone, and now potentially we're turning around. This is probably the weakest area I've seen for copper in some time, and of course it has followed through due to the non-farms and the interest rates. Speaking of interest rates, gold hates forward yields going up, and it got obliterated. I posted about this on Twitter, and it just got destroyed. It went through all of our key demand areas on the 2 hour. So you can see here, it went through pretty much everything and absolutely shredded these levels, which is why You need to wait for usually some confirmation turn. And now we have a strong level setting up around this area. So if we do end up getting rallies in gold, I'm actually thinking for now, at least with these hot numbers, if they keep coming through, gold is short for this time being. Now, I did warn on this channel that I like gold into February. I don't like it past February. Historically, it usually tends to do a little bit trasher over that period, either sideways or lackluster results or anything like that. But this is a fairly large move on gold. And even if you start to consider where we're at, which is, of course, you know, a semi-critical buy zone for gold if it's going to come back. It was bullish, so it might find it. I think somewhere in here is where you've got some serious things. You've got a drop, a base, and a drop right above that 1920 to 1925. You've got serious levels. So if gold starts to rally through the week, DXY weakens, well, you know, several levels that might be worthwhile having on your charts and paying attention to. It may look like there's a lot going on here, but realistically, it's pretty much laser focused on a few levels. What about the stock market? Well, consumer discretionary versus staples, that showed us that the rally was on for risk on stocks. It is continuously on, but as you can see, we got that little out of the middle of nowhere kind of buy. That showed us FOMO was coming back into the market, and it was kind of like an island reversal on this indicator. It rallied to fill the gap, and then it sold back off. So theoretically, it could be the time where we see staples start to find their legs. Unless we get new highs in the stock market, which we'll look at later, it could be that consumer discretionary just hit peaks. In fact, we got alerts on Tesla, which we'll look at very, very soon. US oil did end up weakening. Yeah, we did a bit of topsy-turvy switching in here. At one point, it looked super bullish, and it was about to kind of break out to 88. That 77 continuously showed us that there were switches, and at this stage, it kind of broke lower. So you're thinking possibly demand destruction might even push us back down to that original aim of $65 on oil. Certainly a weak session for it. The engulf followed by this huge weekly down, and you can see here that we're on a little bit of demand. So for some people, you might be looking at small time frame rallies, but overall, this is starting to look like a pretty damn weak chart with oil dropping off. Natural gas has hit what you would call an investor's interesting level. So it hasn't hit a tradable zone in terms of you haven't seen any reaction to the upside, but I did see a few of your comments saying this is investment levels. Yeah, I mean, these are the points where if you buy maximum fear on stocks anyway, you might be able to come in and have a look at it. You've got to make your own decisions, but it's certainly an incredible low. We're going to come back to it. This is why you don't buy the dip on something that is absolutely accelerating in terms of decrease. It could still go lower. It could be under here. Never say never with any price action. It's possible to reach some insane levels. I still remember a few years ago, just to give you a lesson, there's a stock in Australia called BHP, and this particular stock, pretty damn good, as the second, if sometimes it's the biggest, sometimes it's the second biggest. And I still remember when it fell through this level, nobody believed that BHP could go underneath GFC lows. Well, it did. One of the best stocks in the world, especially in iron ore, ended up dropping down to the $12.78. So anything's possible, even with quality, and you've just got to always remember that. Speaking of this stock, of course, in line with copper, it still continues to look pretty weak, and it's got that island reversal we discussed on it. Let's move over to the big stocks, and I've left the expected weekly options highs as of previous week just to show you where the market ended up closing. It closed right around that high level, and we obviously had the set alert here zone, and it just tapped that area and then sold off. So for anyone that was looking at these highs over here and you were thinking that's a great place to take profit, you literally scalped the market like an absolute beast. Let's update together now some of the expected options highs and lows for the week. So we've got 203.22 basically. So we'll just pop it in there as close as we can get it. There you go, 24. And then we've got 176.74. So basically 176, which I've calculated, 74 on the expected low. So we'll just go with 70. Effectively, this is where the market should sit around 68% of the time. And it should hold these boundaries by the close of markets for the end of the week. This was a significant hit though. If the markets are about to turn, maybe this chart and a few others, even when we take a look at Apple, show us the way on that one. It's a pretty significant level. We've now seen that higher high coming through as well. So if we end up getting a lower low under 182, then we rally a little bit. Shorters, I think, could commence around here. Anywhere in here is great profit target taking from Tesla. And it's just because you're putting it in perspective. Remember, investors, you got a different approach. But as a trader, this is a critical zone. It's supply, it's previous support, it's a huge level, and it really is one of those zones where you've got to be ultra careful in a stock like this. I've left up the weekly options expiration so you can see the 200 calls that were outstanding. Yep, they didn't make any money. Bad luck for them, sad face. And the 260s, well, even sadder face for them. But you know what? They were in it to win it, yeah? And that's a massive move that wasn't probably going to happen. Puts and calls, and pretty much most people ended up not making as much as you would expect on that week. But let's move forward to the 10th. So again, 200 remains one of the biggest strikes. But I've got to say, the options is a little bit lower than you would expect. 360,000 units, mostly sitting around 200. I expect this one to realistically get huge. And I probably also expect the puts around those 160s, 150s to get larger as well. Still a lot of calls here. Max pain theoretically a lot lower than where the current stock is, but I wouldn't be surprised at all to see this 200 continuously pump up. I don't know why it is that retail traders or any of us tend to always like buying these rounds, but you've got to be really careful around round options. You tend to get ripped up if you end up buying these big rounds. It's better to actually sell premium on those if you know what you're doing. Let's move over to Apple. We've already updated the expected weekly options highs. I was very interested in the reaction up here. Now, this was a stock that was flying. It was absolutely beast moding throughout the session. It ended up selling off into the close. But yeah, very critical level hit. And Apple just basically flew through so many zones. And what it tells me is with 23% of retail traders doing the transactions, they love two stocks in particular. You guys love the Apples, you love the Teslas, you love the Nvidia. These are some of the top traded, Disney, Microsoft, those ones. So these might be where day traders that understand options may wish to sit over the next couple of weeks, as I'm sure Wall Street will have its plan for retail traders. Amazon pretty much cemented an island reversal. This was the best island reversal trade of all of them. Apple failed, Google worked, Amazon obviously worked towards the short. So we had the gap up and then the gap down. It took out way over what we ended up getting after the options, or after the earnings and before the earnings kind of rally through. It's now cemented a bit of shorting going on here. And if we put it in a weekly standpoint, you can see that huge wick rejection pushing us back down into these closes. That's not really the type of candle you wish to see if you're a bull. That's a big rejection. And it shows consumer discretionary. Maybe there's more work to be done by the Fed. So yeah, it's not good for consumer discretionary stocks theoretically. Nvidia continues to hold really strong. It's above the trend line. And by all metrics that you look at here, it tends to kind of look bullish still. I'm not so sure. I think this stock could have been pushed heavily by retail traders. My aims were always 192. It's above that now. I'm not going to say it isn't. You know, these are the key levels we thought it would turn at. These are the key levels that we thought absolutely it would sell off or at least find some issues. And it's through that zone. I'm going to watch it closely this week as I think we need to bring it up. If you look at the weekly close, everything looks fairly good. I'm going to also watch if we end up rallying this gap close up here, so around that 227. I think it's worthwhile having alerts on that should the market start to fly again for whatever reason. And yes, I know it looks like an inverse head and shoulders. We've proofed it. I mean, it proofs incredibly well. If we are in a new bull rally, everything's pointing towards up here. It's just I'm not so sure when we look at some of the stocks and indices a little bit later on. China, the CQQQ, I'm watching this one, this level, continues to potentially build a distribution. And something I am watching, because of course this was a huge rally, I think it's taking a break in this zone. And depending on how this formation continues, at this stage, it looks like it could be a tip over event that's coming into the Chinese market. IWM Russell, very strong week for it. Hyperstock's absolutely back. It's the same with ARK-K. they're all hitting these kind of key or getting close to key levels. If you look at RK, big resurgence here. I don't really TA this, but these were the zones of accumulation theoretically for investors. You can see the volumes were massive as well. And yeah, I mean, it's still actually quite cheap. I know people think that this is expensive, but realistically, you put it in perspective, it was like 160 and now it's 42. So you're not going back to these levels, but even at the time of this recording, it's still down 73%. So you've got to put things in perspective. An investor doesn't care about picking the perfect bottom, but they do like to get, of course, the what would be considered the beginning of semi-bull runs. So they can run them for like 4, 5, 6, 7, even upwards of 10 years in their portfolios. The Qs, bad week or bad day for the Qs. Big rejection zone off the top. Expected weekly options highs for the week ahead have been updated here. I wanted to watch the reaction to this level. It looks like it rallied and dumped. And this is actually incredibly in line with some other things that we discussed. It's just a week down, but weeks do hold orders. And this is a fairly significant week down on that session. Let's have a look at the futures market action. And it actually kind of did exactly what we thought it would do through the session. We ended up getting a rally. The rally came into that golden pocket and then it dumped off. So is the storyline good for selling? Theoretically, yes. We have highs, we have lows, we have higher highs. Then we have rallies to suck people in. We have a little distribution in here, and then we get these lows again. If we continue through to new lower lows, so that's probably getting through down here around that 12,455, we should be able to get to the bottom of this ascending, or this basically ascending trend line. And this trend line has been where the bigger buyers have commenced. So I think a very important level coming up this week. I wouldn't be surprised at all to see the market get back down to these levels. That's that 12,000 kind of 173 to 200 zone. So certainly worthwhile watching. We've got daily closes and a whole bunch of complements starting to stack on that zone. A point to watch, and at this point, it does look weak, at least temporarily. The trend's still up. Don't get me wrong. The bears haven't got any total commitment here in any of these markets, but it's a level to watch. Let's look over to the SPX. Rejection outside of the Bollinger Bands. We've seen this before. It can start kind of accumulation. It can also start the beginning of sell-offs. But if you have a look through the past, a lot of the time the sell-offs will come back to heavier demand zones, similar to what we saw on the US 100 just before. Yes, it's outside of the Bollinger. It's also on the top end of the RSI. Remember the times we've seen similar kinds of things? Well, this one is no different. Basically, it is a very similar periods of time to before. You've got Bollinger, you've got RSI, you've probably got MACD, you've got a whole bunch of indicators probably showing overbought. I don't tend to bring up indicators very often, but I do like the 20 moving average, which is the middle of the Bollinger. And if the markets do sell off, again, for buyers, they're going to be wanting to look at some of these key levels. Here's the SPY. I wanted to show, again, the expected weekly options ranges. You can see where it closed, just underneath the top end, and of course the bottom at 397. So it held within the range by the end of the week. I'll update them now for you. So let's have a quick look here. And we have 418 and a little bit. So we'll quickly check that on. 418 around there. And then the bottom range, we have the 406 level. So effectively the market could drop this week. Now the 406 is the one I'm looking at in particular, because what that's going to show us if we go over to the futures market action is a 406 pushes us into this bottom trajectory. And we also hit a weekly level, and we also hit probably the same point on that Nasdaq. So for buyers, they're going to want to watch this level. For sellers, you're just going to want to see new lows, probably something underneath this level here. We've already had a great sell zone through the Friday session, 41.14. You're going to want to see that broken below. Once that happens, hopefully a move down to here. And I think this is the level that I'm interested in updating on this week, should we get it. Now, in the unlikely, I guess, experiment, the way we see markets go absolutely flying, and we get a closure above these two rejection wicks, because they look like a tweezer at this point on the futures. So if we do end up getting a bullish closer, we pretty much move higher. Now, we've got unfilled gaps above these zones, but I'm specifically looking at a rally that could freak people out, and that's something like a 43.50. I've done a bit of work on this with some other reasons. I think it's a stacked zone. So if we end up getting past 4,300, we hit between 43 and 43.50. That's probably the final true bear zone for this market. If it gets through there, we've gone plus 20%. I think we'll be, let's just measure it now together, we'd be at a level that's literally 25 plus, which is pretty rare. I don't even know if that's happened before, and we'll do an update on that moving forward this week. So that'd be a 25% plus off the bottom. And I think that the market might go and do some ballistic kind of 1930s stuff after that stage, and maybe even get all-time highs. It'll drop before that, but this would be a significant level for these markets. So I've got a stacked area up here. Certainly it looks weak at the moment. We're going down to the trend line. Watch these levels. They're all very important. I think it's a great week to be involved in these markets. Let's move over to the futures market action. A decent amount of calls coming through, 410s and 415s, the most stacked call zones, and the puts sit at 400. So yeah, those levels are all fairly important. In terms of max pain, well, it's a 406 on the max pain at the moment, and 1.07 million units outstanding. The Bitcoins, nothing much going on with the Bitcoins. The Bitcoins continue to realistically just come off the top of our trend line, and they still haven't broken through any key level. They didn't really rally that much. They didn't fall off that much. I think it's stuck in a range. We've got alerts up the top just in case, and we know what we're looking at. Week ahead for Australians out there, cash rates coming out Monday, 6th of Feb. Then on Tuesday, we have Fed Chair Powell coming out to annoy us, 12 p.m. New York time. Then we have the FOMC member Williams speaking Wednesday at 9:15. Then we keep scrolling through, and we end up with prelim UOM consumer sentiment, 10 a.m. on Friday, the 10th of Feb. If you haven't already, come and follow us on the other social media platforms. Definitely remember to sign up for the 3 free trading cheat sheets, as I will be putting out a monthly data newsletter as well, which we'll have a link to in the future. But if you sign up to that, I'll register all of you guys to it. TikTok, certainly follow us over there. Let's try to get that thing up to 1,000 followers as we join, I guess, the TikTok revolution. But more importantly, what I want to be doing is just providing extra content that's a little bit different, but also gives you a bit more of a snapshot. And of course, we won't stop doing these shows. This is where we absolutely love the community, and you guys have made us what we are. So always, thank you so much for what you've done. Thank you for your comments. Thank you for your likes. And even the dislikers out there, thank you very much. And of course, we hope that you have a good week in trading and investing. It is tough out there, guys, but I'm kind of excited there's so many retail traders coming into trading again. It's just awesome. When I started, there was less. Then there was more, then there was way less, and it's just amazing what's happened since 2019. So thank you so much, and we'll catch you very soon.